Hey there, it's Ben from Ben Finance. Look, if you're sitting there right now, staring at your phone or your laptop, feeling like the whole world of investing is this massive, tangled mess that's just too much to handle, I get it. You're not alone in that fog. Maybe you've got bills piling up, or you're hearing all this noise about the stock market crashing one day and booming the next, crypto going wild, AI stocks exploding, and then there's inflation eating away at your savings like it's nothing. It's 2026 and things feel more uncertain than ever with the economy bouncing around post pandemic recoveries, interest rates flipping like a coin, and everyone on social media screaming about the next big thing. You think, how am I supposed to figure this out? I'm not a Wall Street wizard. I'm just trying to make ends meet and maybe build something for the future. That confusion hits hard. It makes you freeze, right? You scroll through apps, read a headline here, watch a video there, and end up more lost than when you started. It's overwhelming, and it feels like if you make one wrong move, you'll lose everything. I've been there staring at my own accounts thinking the system's rigged against regular folks like us. But but here's the thing, and I say this as your reluctant mentor who's seen the other side. That fog, it's not real. It's manufactured by the noise, the ads, the fear mongers trying to sell you complicated schemes. Investing isn't this beast you have to conquer with fancy degrees or insider secrets. It's actually not complicated at all. It's just about putting your money to work in a consistent, boring way that compounds over time. That's it. Strip away the hype, and you're left with simple math and steady habits. No drama, no guessing games. Once you see that, the overwhelm vanishes like mist in the morning sun. Let me break it down for you logically because fear thrives in the unknown and logic is its kryptonite. Think about it. The stock market has been around for over a century. And despite wars, recessions, bubbles bursting, it keeps going up. Why? Because it's tied to human progress. Companies grow, innovate, and make profits. And as an investor, you're just hitching a ride on that train. But the media loves to zoom in on the daily dips and spikes to keep you glued and scared. In reality, if you look at any 20-year period, the S&P 500 has averaged about 10% annual returns, including dividends. That's not luck, that's history. So the clarity here is that investing boils down to three stupidly simple truths. Time in the market beats timing the market. Diversification protects you from dumb luck, and low costs keep more money in your pocket. Forget day trading or chasing hot tips. That's gambling, not investing. It's just consistent contributions to broad, low fee funds that track the market. Boom. Clarity achieved. No more feeling like you need to be a genius to win. Now, let's pivot to the solution. I got you. We're fixing this together, step by step, without overthinking it. First off, mindset shift. Stop seeing investing as a get rich quick scheme. It's a get rich, slow reliability plan. Start by assessing where you are right now. Grab a pen and paper or your notes app and list out your monthly income, expenses, and any debts. If you've got high interest debt like credit cards over 15%, pay that down first because it's like investing with a guaranteed return. Use the debt snowball method. List debts smallest to largest. Pay minimums on all but attack the smallest one aggressively. Once it's gone, roll that payment to the next. It's psychological wins that build momentum. But assuming you're debt light or managing it, let's talk building wealth. Step one, set up an emergency fund. This is your safety net. 3 to 6 months of living expenses in a high yield savings account. In 2026, with rates around 4 to 5% thanks to the Fed's Balancing Act, places like Ally or Capital One are offering that without fees. Automate transfers from your paycheck. Even $50 a week adds up. Why? Because without this one car breakdown derails everything and you dip into investments at the worst time. Logic, peace of mind lets you invest boldly. Step two, open a brokerage account. Don't complicate it. Vanguard, Fidelity, or Schwab are gold standards with no minimums and user friendly apps. If you're in the US, go for a Roth IRA. If your income qualifies under about $153,000 for singles in 2026, because contributions are after tax, but growth and withdrawals are tax free in retirement, or a traditional 401 if your job offers matching, that's free money, folks. Max the match. It's like an instant 100% return. Inside these, invest in index funds or ETFs. My go to, Vanguard's VTI for total US stock market or VXUS for international exposure. Low expense ratios under 0.1% mean you're not bleeding fees. Why index funds? Because 80% of active managers underperform the market over time. Logic again. Don't pay someone to guess when you can own the whole haystack instead of hunting needles. Step three, automate everything. Set it and forget it. Use dollar cost averaging. Invest a fixed amount every month, rain or shine. Market high, you buy fewer shares. Market low, more shares. Over time, it smooths out volatility. Say you can swing $200 a month, that's $2,400 a year, at 7% average return, conservative estimate after inflation in 30 years. That's over $200,000. Bump it to $500, $500,000. Tools like Acorns or Robinhood make this effortless with roundups from purchases. And in 2026, with apps integrating AI advisors for free, you get nudges without the overwhelm. But wait, what about risks? Let's dissolve that fear logically. Diversification. Don't put all eggs in one basket. A simple portfolio, 60% stocks, 30% bonds, 10% international, or even a dash of crypto if you're feeling it, but cap at 5% for sanity, rebalance once a year, sell what's high, buy what's low. Volatility, it's normal. The market drops 10% about once a year, 20% every few years, but it always recovers if you hold. Remember 2020? Crashed 34%, then roared back. Those who panicked sold low. Holders won big. View dips as sales and taxes. In taxable accounts, hold for over a year for long-term capital gains rates, 0-20% versus your income bracket. Now, for the fun part, let's add some 2026 specific tweaks. With AI booming, consider funds like ARKK or QQQ for tech exposure, but keep it under 20% of your portfolio. Inflation's cooling but lingering, so TIPS, Treasury inflation protected securities via funds like VTIP Shield, and sustainable investing. ESG funds are maturing. Check Vanguard's ESGV, but don't chase trends. Stick to basics. If you're side hustling, funnel that into a SEP IRA for self-employed folks, up to 25% of income tax deferred. Education is key, but keep it simple. Read The Simple Path to Wealth by J.L. Collins. It's like this talk in book form. Or listen to podcasts like Choose FI while commuting. Track progress with apps like Personal Capital, free net worth tracking, and community. Join Reddit's R Personal Finance or Boglehead's forum for real talk, not hype. All right, let's paint the picture of what life looks like after this. Imagine waking up in 5 years, checking your app, and seeing $50,000 grown from consistent drips. Not because you timed anything perfectly, but because you showed up steadily. No more lying awake, worrying about retirement. Instead, you're planning that family trip to Europe because your money's working harder than you are. In 10 years, that compounds to 6 figures, and suddenly options open. Cut back work hours, start that passion project, or just breathe easy knowing market dips don't phase you. Fast forward to retirement, you're not scraping by on Social Security. You've got a nest egg throwing off $40,000 plus a year in dividends and growth tax efficiently. Freedom, right? More time with loved ones, pursuing hobbies, maybe even mentoring others out of their fog. It's not about Lambos or mansions, unless that's your vibe. It's about choices. No boss dictating your life. No debt chains. You're calm because the system's on your side now. You've dissolved the fear with logic, and life's simpler, lighter. But hey, don't stop at basics. As you grow comfortable, layer in dividend stocks like VYM for income streams, or real estate via REITs like VNQ property without the landlord headaches. In 2026, with remote work solid, consider geographic arbitrage, invest while living cheaper, and health, tie it in. Better finances mean less stress, better sleep, longer life to enjoy the wealth. One more thing, mistakes happen. If you buy high and it dips, hold. Logic. Time heals market wounds. Review annually. Adjust for life changes like marriage or kids, and give yourself grace. Starting is the win. We've covered the fog, cut to clarity, pivoted to actionable steps, and glimpsed the hopeful horizon. I got you. This is doable together. Stop complicating it. Start getting free.